Hello, our biggest fans. This is another episode of
How do you
Snakes
know
and
our
Ladders.
biggest fans are listening?
Well, because they're our biggest fans, they'll be listening, obviously.
How do you know we have fans plural?
Because we all have parents.
Welcome to another episode of Snakes and Ladders. I'm here with my two esteemed co-hosts, as always. You've got Charlie Lambert and Jimmy Lee. This is the place where we insert our banter. How are we?
There's nothing like prescribed banter sections to get the real best out of us, I find.
Forced fun for all.
Yeah.
Actually,
how's
to be
everyone's
fair,
week been?
Oh, sorry, but to be fair, have you ever watched, what's it called, Taskmaster? The forced banter bit on there, I'm always amazed that they actually do pull that off. It just shows you that funny men can actually be funny. On call, we fall flat.
I'm way too busy to be watching that sort of thing. I don't know what you're doing. I'm working on our business, but any news from this week at all, apart from what we're about to go through?
Any news?
Apart from the... No, go on, but hang on. Before you get into the serious stuff, Jay. News from the week. Number one, I actually don't have an update on this. Are the cars now safely carcooned?
No.
Oh, for fuck's sake! That was the big hope for the week.
That was the call I was going to hit you with later. I just got back from there, and they're not working, and they're not in a carcoon.
For our audience, can we give a bit of context as to what you two are rabbling on?
So Mr. Lee and I both love cars and realised a while ago that all they do is ruin you financially. So it would be much better if we were going to collect them to do that together. And I mentioned on the pod before we need to buy shares in Carcoon because we can't get over how much you can charge some plastic to put over a car to keep it safe in winter. We've just bought a couple of these, which went down to the farm, and I've been waiting for a lovely photo of it looking all snuggled up in its thing, and it turns out not only is it not in there, but it didn't start either. So no surprises across the board there.
It's not in there. Sorry, what?
Well, not only is the car not in the carcoon yet,
I thought you meant
turn the things on.
Okay, I thought you were saying the car's not in its location, that maybe it'd been pinched.
It's gone, stolen.
No, the problem is the car has been in the same location for too long and now doesn't want to move.
Yeah, well, that will happen. As car nuts, surprises you two so much, I suppose. Anyway, let's move on into the general markets. Jimmy, take us away, please, sir.
Well, I think, Ben, you were going to give us a nice synopsis on Donald Trump being in Davos this week, weren't you?
Well, hang on. So to our fans, our huge fans, we were just having a little pre-chat before the podcast, and you know, this might get me cancelled off the bat, but I've kind of always been a Donald Trump neutralist. You know, really, it hasn't really affected me that much. I just think he's quite funny. However, I would say recent events, and I think Patrick would say Venezuela, for me, Greenland, it's the first time I've gone, crikey. He really is doing something I've never seen before. Even when I heard at the mid last year, beginning of last year, when he was talking about buying Greenland. I mean, it just amazes me, I suppose, on the geopolitical scene, how many things I don't even think are possible. And then somebody comes around along with a wild idea like that. And then obviously there was the military threat, which I'm hoping is just a bit of saber rattling and not really there. But, this has all suddenly gone, I think on a world stage, political leaders are all thinking, bloody hell, we've never had anything like this before, certainly not in at least past 50 years. What the hell's going on, right? And as we've seen in Davos, even on, I suppose, the most respected political global stages, there's been a sort of a little bit of jibes, jeers, all kinds of things. People are reacting quite badly to this. It's all started to turn into a bit of a circus.
Yeah, I mean, there's two sides to this. There's the really quite funny, if we're honest, the whole sort of toys out of pram tantrum of this man who's supposed to be leading America
because he didn't get the Nobel Peace Prize. Of course, that's the reason, right? From the text messages.
Yeah, and then his plane doesn't work and all this stuff. But underneath it, I mean, I got to say, biggest sort of toughest job out there now is being everybody else, right? Because you're effectively dealing with a toddler who does have huge power.
Yeah, huge power, yeah.
We can't deny that. On the flip side, if you're Europe, you have got to call bullshit on this, because the one thing you know about bullies, you don't stand up to them, they'll just keep taking. This will be the first point. To your point about the lens, it's really shifted it. He's sort of setting himself up in Putin camp. You can't just, this is not the way to behave, and it's not the way we've ever seen really a US leader do something. And or certainly in my sort of knowledge sphere, it's sort of deeply worrying, and I think really tricky and really difficult from a how how do you plan your strategy around it? Because, of course, the number one thing this has reintroduced is a whole bunch of uncertainty. We started the year with a reasonable pep in the step, didn't we? All of us are going, well, kind of surprised, and we thought there was an AI bubble, and maybe there's a bit more to go there, and da-da. But now everything could flip-flop.
Yeah, no idea.
It's like, Jesus, and what is he doing?
Markets are resisting some things you wouldn't think they were. Markets are completely tanking on others. I mean, it seems like chaos. Jimmy, bring us a slightly more salient view on what might be happening.
Everything's down.
Yeah, yes.
That's my role, Jimmy.
Except for gold, pretty much everything's down. But I think you're right. The problem is people don't really know how to price this. What does it mean? How far is he going to take it? I read something earlier where they were talking about, because obviously Europe previously was so reliant on energy from Russia, then Russia invaded Ukraine, so Europe turned the taps off there. So now Europe is highly dependent on US LNG exports. If we don't give him what he wants for Greenland, is he likely to weaponize energy supplies from America to Europe just to try and make life that much harder? The tariffs already we know about. So I think it's a terrifying situation where you wonder just how far he is willing to push it. And also the Europeans up until now have kind of tried to play the, let's appease him. Let's just try and be as nice as possible in the hope that he doesn't lash out at us individually. And now they're kind of going, well, it feels like that strategy is off the table. Now, how badly do we want to go back and accordingly? And he's obviously talking at the World Economic Forum today, and that will be interesting. But even the manner the US have turned up there is very much so. I can't remember his exact phrasing, but Howard Lutnick saying something like, this is the new face of capitalism, talking about Trump. And you're just sort of going, I mean, this is just not liable to rub anyone up the right way.
Yeah, the new face. I mean, calm down. New face of capitalism.
Do you think it feels seminal in the way that he pulls this off or doesn't? To me, I think it's entirely plausible that if Europe were brave enough to take a short-term pain, this could cripple America in the long term. This could be the moment, because what it does is more naturally moves us closer to people like Russia or China. I mean, I know they're unrelated, but we just signed off on this new massive Chinese embassy in London. And, the obvious thing is you go, oh, well, if you're not an ally, where else do we get them from? And America could really accidentally tip us into other people's negotiation. Also probably puts a spotlight back here at home on the fact that we've not really done a very good job of preparing ourselves, food, energy, the whole thing, right? We've just allowed it to come from elsewhere for a long time. But nevertheless, there is enough economic weight. And I mean, you heard it here first that maybe this tips us over stopping having a reliance on the US big tech and all that. If it could become an actual entrenched trade war, I would suggest in the medium term, that would look really bad for America. And
short to medium term, I would say. I mean, there are obviously political cycles. How long has it got? 4 years,
Well, short term, I'd imagine it hurts like hell here. Actually,
for sure.
I think in the short term, he's got the power, but in the medium, that's where it could run out. But you're right; he will run out of power, thankfully.
Yeah, well,
everything through executive
do they
order,
try and tread water in some wild way? I mean, 4 years. The thing is, he's done this pretty early on in his second term, right? And he's done it for a reason. I don't think they're going to have the runway to be able just to tread water and sort of try and wait for the next administration.
I think you've also seen all the European the banning of social media for under 16s in Australia. Now, all the European countries will just say, right, under 16s, no social media. We're going to bring back all the big tech tax that we were talking about, but we didn't bring in because we were afraid of US tariffs. All the US agriculture, agricultural products and machinery that we import, we're not going to import anymore. So there's a whole raft of things that Europe can kind of deploy to leverage their position. But you're right, fundamentally, it's not good. It's not in anyone's interest to kind of have to go down this path. So you would hope that sense prevails and something, can be resolved. But it is difficult to see where the light is at the end of the tunnel on this one.
So on the markets, obviously, we have seen a little bit of a reaction this week, right? Everything's down, Jimmy. Why? I suppose my question to you is, Venezuela, nothing seemed to happen. In fact, defense stocks went up. There were certain obvious sort of reactions to it. But from an overall point of view, the market didn't seem to actually flutter at all. Whereas now, it seems like everything is tanking. Is there a specific reason you think? Is it just the sustained sort of madness of this?
I think it's more to do with geography. I mean, Venezuela is a long, long way away from Europe, and frankly, it's a Latin American problem, is kind of how they'll be viewing it. Whereas Greenland is most certainly on our doorstep, and that's more worrying for the likes of us. A big part of why you've seen the kind of commotion is also because so much in terms of the NASDAQ and big US tech names are priced to perfection. And all of a sudden, does this complication mean that Nvidia won't sell as many chips? Does it mean that all of a sudden taxes might change on Amazon goods in Europe? And so people are going, actually, perhaps we'll take a bit of risk off the table. But also, you've seen, so the inflation data in the UK came in a little bit hotter than expected. Has that had an impact? And also, fundamentally, you know, the market's was up 3.5%. I think the FTSE 1 beginning of this year. So it's going to be up and down and all around, and let's kind of see what happens over the coming weeks. But one of the more interesting bits this week was the next turn of the wheel in the Netflix, Warner Brothers, Paramount deal.
I didn't see that coming, did you? That they'd go cash. Why do they want it that badly?
It's more because their share price has come off so much. So doing the deal in shares is actually now a lot less valuable to the Warner Brothers shareholders.
I sort of understood that part of why they had to, but it surprised me that they were willing to. I mean, they were already being backed, and you know the board was suggesting they were the one to go with. I'm surprised they didn't just sit on it a minute, go, look, we're still Netflix with a giant. You really, you want to sell here. I know it doesn't look as attractive. Well, when you're ready to negotiate and you're already committed to us, we can sweeten the deal. I was quite surprised. I mean, I thought it was a big move to go all cash. It's aggressive.
Well, the other bit of it is you wonder. So Netflix announced their earnings after market last night, and their shares are down, I think, 6% in pre-market trading, based on not getting the subscriber growth they wanted. But there were a couple of really interesting comments that the leaders said on the earnings calls, and actually they're quite relevant to us and what we do. One of them was, YouTube is not just a user-generated content and cat videos platform anymore. And the other
one that's been the case for a while. No, I didn't. I thought that was spun as new news and didn't feel.
Yeah, sorry. Can you just give us the context as to why on the Netflix call they are talking about YouTube? Because people would see YouTube as
watch more than terrestrial TV.
Exactly.
Now,
but YouTube, I would say, is Netflix's biggest competitor. In fact, it's the only entertainment media service that's bigger than Netflix globally, right? So why are they using YouTube as a benchmark?
Well, I think what they're trying to do is paint a picture. And the other comment is, TV is not what we grew up on. Oscars and the NFL are on YouTube. Networks are simulcasting the Super Bowl on linear TV and streaming. Amazon owns MGM. Apple is competing for Emmys and Oscars, and Instagram is coming next.
That's completely
so
true.
they're kind of painting a picture of, actually, we know that we've had the market dominance and the lead for a lot of time, and Disney's kind of faltered with their Disney Plus platform and blah, blah, blah. But now they're saying, actually, this landscape is looking unimaginably competitive versus where we once were.
I quite like Disney, by the way. I have Disney. It's quite good. I only have it because if you go to Disneyland, they give it to you for a year, so we keep going every year. We keep getting Disney Plus, but I actually do watch it quite a lot.
You go to Disneyland every year?
Yeah.
I suppose that's your American, your American side of the family.
Oh my God, when Courtney hears that, you're in trouble.
Fact.
It's actually her Danish father that takes them all. Yeah, it's all him. He's absolutely mad about it.
My parents always refused to take me because it was naff. Sorry.
Oh, dude, I don't disagree. My job is to walk around with the buggy while everybody enjoys this slightly weird
you
place.
Must look dreadful. God, I struggle to walk around with a buggy on the street, let alone in Disneyland.
You must look dreadful. Look like Dad of the Year, mate.
Do you hold the handlebars with both hands?
No, because I'm normally on the phone to you.
Okay, well, that's fine. Someone asked me the other day, someone was like, who's an expectant dad? He's like, I really just don't want to be seen as a dad. And I was like, the key to that is push the buggy with one hand. As soon as you do it with two hands, you look like a dad. As soon as you're one-handed, you're something else as well. You're a bit more than just a dad. Anyway, no tip for our fans.
Next up, no, I mean, I think so. Just to close on Netflix, who knows what will happen next? But I think it is really interesting how they're talking about this content arms race in terms
They are
of
completely true. And, they didn't mention TikTok. They're talking about Instagram. I think TikTok's going to be ahead of Instagram, personally. I think TikTok's going to be I think it's changing formats, right? I think you're going to be getting serializations, 5-minute TV series from big people. The format, everything's changing to suit this new landscape.
Massive insight there, right, Ben? Because I thought really interestingly, we were doing a bunch of community stuff recently, and 2 or 3 separate people said to me, Instagram is dying for me. Well, the people that are at the trend end of this stuff, because Instagram is now so dominated by ads and suggested posts.
Yeah.
That home feed in Instagram is you scroll and go suggested for you, suggested for you, suggested for you, a friend, suggested for you, we don't have patience for that. We'd like, no, bugger that. We live in the world of choice, right? We'll just choose to swap to the platform that's actually serving us the friends and the people we were there for. I thought that was massive. I was like, oh my God, yeah. So I think you're right. TikTok, interestingly, haven't mentioned it. I guess there's some political reasons why, but agreed. I think that is where the content consumption is going. But I would mention again on that light that YouTube very quickly and very seamlessly integrated shorts very cleverly. They've really kept themselves on the map there.
Yeah.
But
become seamless part of their experience.
There's road to run on those shorts. If we're talking about it from what they talk about the Netflix, it's how do you deliver narrative content? The YouTube Shorts is an Instagram sort of social content creator feed. I still think there is a combining of what we know as sort of longish form entertainment narrative, what you know from Netflix or some of your sort of old school, HBO, things like that. And then there is this new TikTok format. I think there's going to be I don't know how many years, 5-6 years, you're going to get this crossover of formats where you'll get narrative series, but purely 5-minute episodes, things like that, purely for TikTok. And you might find in 10 years' time that is actually the main form that people consume entertainment, scripts are written, etc. By the way, while we're just
forget how short they used to be there, didn't they? What's 2.5 Men's only 20 minutes an episode anyway because of all the ad breaks.
Oh yeah. Fair. Well, I mean, the UK episodes are 24 minutes because you had 6 minutes worth of ads. That, to be fair, that's when I was first studying.
When you were a nipper
time ago, I'm sure that ratio is adjusted.
Also, before I forget to mention this, and I will let you finish, I promise, but before, because otherwise it will go, is we are, of course, delighted that Netflix are going all cash and are going to win this bid because we are investors in Netflix, and the dashboard will tell you that it's one of the main reasons our portfolio is already down. So we're off to an absolute win on our
You know what? Learn along with us. This is what happens. This is the start of the journey. It's going to go down even more, but in 10 years' time, we'll be able to go get ourselves a coffee with the wind.
We have lost ourselves. What is this? $5.45 already.
Okay. God, Jimmy actually looked really pained there.
Did we start with
that is not a man
$5.45?
used to losing money. I just saw his eyebrows went to the top of his head just then.
What was that on a $92 investment? So no, 5%.
Oh, that's bad enough, to be honest. Talking percentages. I was just going to say on the Instagram thing, I'm probably the only person in the world that actually goes on Instagram to be suggested things to buy because I love buying stuff so much. I don't go for the content. I want to be served ads that I want, and at the moment, it's serving me ads for bags and 3-inch insoles to make me taller.
Really?
Constantly.
Insoles?
And I am so close to buying them.
So on the next week's podcast, when you're like foreheads cut out of frame, we'll know.
Honestly.
Oh my God.
Honestly. Anyway, sorry, Jimmy. Please take us forward, buddy.
No, so the conversation this week was about investment trusts. What are they? Why should investors know about them? Because they are a slightly sort of niche is the wrong word, but they're sort of pretty much a London market only vehicle. They have a very historic track record, but they're essentially a listed vehicle where investors can buy shares in a company just like you would any other listed business. But the trusts are not like normal listed businesses. They're actually sort of vehicles that give people access to other companies' offerings. So, for instance, investment trusts can be focused on buying shares in other companies or bonds or property or infrastructure or private companies. Or if you want, there's a number of investment trusts that are focused on investing in regions of the world. So there's quite a few Vietnam-focused investment trusts and North America-focused growth investment trusts. But it's essentially giving people a bit of diversification. They tend to be professionally managed. So Bill Ackman has his Pershing Square Holdings investment trust in London, which obviously he kind of
Jimmy's
manages.
definitely just talked his
it
book
follows
there.
his Pershing Square hedge fund. No, it's actually one of the ones on here that isn't one of mine. But what kind of is the difference between an investment trust and a fund? Well, an investment trust has a fixed number of shares. The shares trade on the stock exchange. They can use leverage or gearing to increase exposure to things, and the share price can be above or below the value of the assets, which is the kind of premium or discount that the value gets placed on the trust, which we'll go into a bit more. But historically, a lot of the investment trusts have traded at quite a tight discount, or even with sectors are really hot, like in the tech sector, when it's really hot, occasionally the investment trusts focused on tech trade at a premium. But at the minute, it's pretty normal for an investment trust to have a discount. And it's kind of one of the areas that all the investment trusts are talking about at the minute is how do we narrow the discount versus our net asset value?
You said you're going to go into it a bit later. Can you just go into that a little bit now? Sorry, when you're talking about a discount or a premium.
I might be a good moment because I was quite grateful we brought this up, so it made me go into it. And the first thing I Googled and discovered everyone was doing the same is how it's different from an ETF, right? Because in sorts of ways it is. So net asset value would be the theoretical value of everything that they own, right? If I own a can of Coke and I can sell it for £1, then my net asset value is £1. And then if you add up the price of their shares times the value of each one, does it add up to £1? No, it's 95p, right? Then that's the discount that Jimmy's talking about. And why might that be the case? Well, there's various things. It's whether people believe in the management, whether they think they could actually realise that if they were forced to sell. It's faith in them. But actually, the deeper I went into looking at this, the more I realised this is actually a really interesting area of opportunity. You can get the diversified risk of an ETF with the potential upside of buying something that's discounted to net asset value and may well catch up. Now, you have to be a bit careful because they can trade at a discounted value for a very long time and it may stay wider than you want. But there is real opportunity here to effectively buy a £1 can of Coke for 80p if you time it right and you find the right trust that's just kind of out of fashion at the time. I thought they were kind of fascinating.
I think the thing that I picked up on there was, say, the management of it. So, you can find that investment trusts are often traded at a discount purely because people don't believe in the current management, or the management don't have, a great PR stroke.
I think it would be fair to say it's less of a personal management thing, wouldn't it, Jimmy? It's more about the philosophy of the shares they grouped, the things they've chosen to invest in, rather than direct.
Yeah, and I think you also have this slight nuance in London where there's a lot of them. Some of them are subscale versus others. So, for instance, some of the largest investment trusts in London, the most famous ones, Scottish Mortgage Investment Trust, which is a market cap of circa £13 billion. It's run by Baillie Gifford, which is a very well-known Scottish investment house, well-known for backing very long time horizon, backing tech. So their largest position is actually in SpaceX. Which they got early doors, and they're also in a number of other tech firms. Now, in 2020, 2021, that trust traded at a premium because during the pandemic, tech was so hot that everyone needed as much of it as possible. Whereas in 2022, when there was a bit of a market correction, it then went to a discount as all the big tech names sold off. Now I think it's still on a discount, but it also depends on liquidity. So generally investment trusts that own shares in liquid assets like other equities or bonds, they're more liquid. Whereas if you're an investment trust focused on, say, commercial property or big infrastructure or whatever it is, they're less liquid, so you attach a higher risk premium and therefore a greater discount.
Yeah, I mean, it's also even
level to it, because obviously you can't
basic discounted return on cash flow, you have to have some discount if it's going to take them 6 months to sell it. That's always the thing.
Sorry, the dumb question here. You're trading an investment trust on the stock market. So actually, your investment on the stock market with that investment trust, is that still liquid in an investment trust that might not have liquid assets?
Yeah, you could sell it to somebody else, but of course that's where this discount comes in.
Yeah.
That somebody else says, "Well, I'm buy it off you, but I'll pay you 80p in the theoretical pound, and you bought it at 82, so you're gonna have to take a small hit on that." And that's the fluctuation. But I mean, but this is a lovely example. Jimmy's just given it. Investing in SpaceX, we've talked about how massive we think that is. Here's an opportunity to effectively buy their privately held shares in SpaceX for a discount because of people. So look, you absolutely need to do your own research here. But if there is the people that are watching this and the journey of sort of actively paying attention to investments, the more I read, and this is me learning, we're all learning on this journey together, the more I went, there are definitely some interesting opportunities in that. And the fact that this is trading at a discount, but we know that there might be an IPO just vaguely on the horizon for businesses like that, you go, my God, that could be phenomenal, right?
Yeah, and there are also things. So some investors obviously like things which have a high income or dividend yield. At which point, the renewable infrastructure trusts, where it's wind farms, solar, you name it. I mean, some of those can pay a dividend of circa 10% a year. Because obviously it's not that easy to sell wind farms, so there's a bit of a discount to it. So the dividend has to be at a certain level to counteract that. So they are a fairly unique London-based thing. I would also say that some of them have had the most unbelievable track records. I mean, for instance, HG Capital Trust, which is an offshoot of HG, the private equity house, I think has delivered 52% share price return over 5 years, so 10% a year, but it's done a CAGR of 19% since inception, which is obviously a phenomenal track record.
First time I've ever heard it said CAGR.
Visma.
Shit, do I say that the chavvy way?
Well, how do you say it?
How do you say it?
How? CAGR?
CAGR, not CAGR.
Oh, we're gonna have to do this.
I'm
on
Jimmy's side of always.
Right, that's definitely classier. Fuck, scone it up over here.
So yeah, I mean, there are lots of different trusts that have delivered really impressive returns for people over the years. Obviously, do your own research. It slightly depends on where you want to sit, but as a way to diversify your risk, so you're not just investing in a single company focused on something. If you want to particularly leaning to, say, infrastructure or private equity or particular type of corporate bonds, of course, there is a charge. So an ETF, there's obviously a very minimal charge. This will be a higher charge, and it's all in the sort of key information documents. But they're a really interesting tool to kind of have in the investor's toolbox. And some of them are invested in the most amazing things out there. And there's kind of something for everyone, depending on what your flavor is.
Yeah, and I think that access to companies you might not have had otherwise is a key way that they're really powerful, right? Like a SpaceX piece. And but you've rightly made the same point I was going to, which is just you've got to be aware of fees. They compound as well as the return, so you do just need to think about that in terms of what it's cost you to do it. But yeah, I thought really good topic for the week, and you have beautifully managed to mention a couple of dicey roll options as well there. So we'll go to that later.
Perfect. Well, I think that's everything that I kind of wanted to touch on for investment trust. But if any of our listeners have any questions or curiosities or want to learn more, then shoot us a comment
Jimmy
or an email, and we'd be happy to discuss it further.
Which I guess is a rather beautiful segue then. Oh God, I've got to work out my screen sharing. The risky roll returns. Dun, dun, dun. So, adding to our portfolio this week, you have the choices of the Scottish Mortgage Investment Trust, as advertised so beautifully by Mr. D. Definitely not talking his book. It has, as we just mentioned, a large discount to its net asset value. It has exposure to AI. Well, maybe that's good, maybe that's bad. But space and private tech, kind of interesting. If they get liquidity back into this, so if there is a listing, then there's a real bull case for this particular trust. The private valuations is one of the things that's always really tricky in investment trusts generally, because obviously if you own a private company, how do you value it and how often? But if that stabilizes, that could also help. And likely that would then cause their discount to net asset value to narrow, and for this to be a really good investment. The bear case for these guys, like if rates stay higher because they've got some leverage in there, and we've already alluded to it, but there is still a growth question, especially while temper tantrum runs around the world trying to seize other people's territories. So number one, the Scottish Mortgage Trust. The next one, HG Capital Trust, run by, who did you say?
HG, the private equity fund.
They go for enterprise software. So I think that's quite interesting in itself, because we've definitely spoken anecdotally about how AI might affect that in the medium term. But at the moment, that's more defensive. That's lots of enterprise software that's already deeply embedded in big companies. So while the AI question rumbles on, this is quite a good way of getting a return. Also trading at a discount and generates great cash. And, that's the great thing about these things. Once you are properly embedded and people are using you month on month, they're just paying their subscription fee. So it's a great cash generator. Bear case for these guys, if private valuations again is an issue, if it lags the public market reality in particular. So if we're seeing that they're kind of overvalued versus what they should be because AI has taken a bigger chunk, for example, then you may see this drop off. But HG Capital Trust number two, number three, Manchester and London. Two iconic cities there. This is quite a concentrated portfolio on US tech. So, do with this what you may. We've spoken a little about where we think that might sit and whether it's already priced to perfection and all those sorts of things. But, it's totally believable that we get another year of raises. We've said it here, whilst we're nervous of the bubble, actually there's lots of reasons that there may be a tailwind that makes that run longer than you think. It's quite actively managed. However, the bear case here, fairly obvious. I think we could see a real drop off in what people are willing to pay for US tech if things were to drop away. And then the last one, the JP Morgan American Investment Trust. What was it? How did you say it earlier? American Investment Trust.
American.
Thank you very much. I quite like the tagline.
So we've offered people tech, and more tech.
Correct. I hadn't even spotted that until I've read that. I was just happily going on, going, "Oh, this is nice."
Only old world Jimmy would notice that there's all tech.
He's quite right, but do you know why I actually could put this one in? I got obviously the old AI research bots out here, and it gave me my long list.
That is the reason you come to this podcast. Insight.
Is the tagline that this one generated. It's like, oh, you should do this one, and here's the tagline. I just love this so much. This is the grown-up way to own America when you're not sure what breaks next. I thought, given what we were talking about, this had to make it in. So
that's excellent.
Yeah.
That is the tagline for this one.
Okay,
US equity exposures, historically good at navigating. So that is option number 4, which I'm going to forget the second I switch onto the roll. But as ever, Google, who of course we're all leaving shortly because the EU will ban us from using them, lol, stepping in with its stunning animated dice roll. Drum roll, please.
Go number 4. Let's go. Let's fucking go.
No, so we're HG. Managed by who? Oh wait, HG. Yeah, that would be it. Congratulations.
I roll from Jimmy.
So if I just jump over as a reminder for anybody who is new to the podcast, here is our little dashboard of shares that we've bought so far from the roll. And the point of this is absolutely not to encourage anybody to select their next purchase by rolling a dice. That is just a mechanic for us to buy it here. But for you to see that as we talk about the different investment vehicles and types and how you might approach something, we're just going to buy a share in any of them, and then you can track how that performs over the year. And as we could discover right now, observe our downfall in Netflix as of today. But there you go.
It could be argued that rolling a dice is actually more research than what I put into my stock.
I would say definitely for your first ever portfolio, that might be fair, would it? Yeah.
Well, thank you very much. I felt that it was kind of like a bit of a chaotic but an excellent episode. It's interesting. I was meeting a client the other day, and the client brought in one of their
Sure.
clients into the meeting, and they said they'd watched this podcast and thought they were all pissed on wine. They go, and she said it to me as if it was obvious. She goes, "You obviously drunk a lot of wine beforehand," and I went, "No, it's the middle of working day, babes."
What an excellent idea, though. Can we start doing that? Maybe we could do a whiskey tasting while we're on it.
I'll be asleep by the time that certainly when Jimmy gets into it, I'll be fucking fast asleep. Anyway, thank you so much for your continued patronage of this podcast. We love you very much, and we'll see you next time for another Snakes and Ladders.